Hello and welcome everyone to the fifth episode of the ATC Tape Reading Podcast. My name is David Torres and I'm a current student under ATC. A little chat room plug before we get started. If you find any of this content interesting or you want to learn more about tape reading, market makers, market structure, supply and demand, feel free to comment below and we'll get you in our chat room. Each new member gets our 1 through 4 course setup. So that's like a 12-hour course where you can see what prints, tell us what specific trades to take. And we also have morning live meetings where Rich holds a pre-market meeting where he breaks down the expectations from that morning going into the open. And then we also have a weekly live lesson on Tuesdays called Traders Exchange where students send in questions and Rich breaks them down live. So if you are interested, feel free to comment below. And it's my pleasure to introduce Rich Lepis, CEO and head instructor of ATC. Rich, I'm glad to have you back.
Hey, how you doing, Dave? I know I've been gone for a little bit, but I am back in business.
Sweet, just makes the content that more exciting. So let's jump into it.
All right.
So first question, this is kind of going to be a sneak peek into a series that we're kind of working on in the back end. It is going to be swing trading series. So in swing trading, in terms of tape reading, of course. So my first question is how do you approach your swing trades? I know we're focused on a day trading methodology and the tape tells us what specific day trade we're looking to take 1 through 4, but also like we see a lot of opportunities to do swing trading within I mean, we're there at the computer all day and we're looking at longer term prints and we see those setups come into play as well.
Yeah, so it's an interesting thing. So I'm going to start off by saying that it's not that I'm not qualified to teach swing trading, but I don't, because that's not where I make an abundance of, of my actual profit. Day trading is by far my forte, but there's really kind of two ways that I look at it. So the first way that I look at it is longer term. Now, swing trading typically is, by definition is about, 1 to 5 days, somewhere in that area. But a lot of times, the prints that we see are telling us that they're going to be a lot longer term. So one of the things that we talk about all the time is print personality. And essentially what that means is just what on average that a market maker is trading within their position for that specific day. So if the print personality, let's say, is 4, and we see a burst of 4 prints, we could kind of expect that to happen within some point of that day's open market. But what changes is when we get some type of prints at a major level. And when I say a major level, I mean, it's basically zeros and fives. So $5, $5.50, $100, $150, somewhere in that realm. And when we see something way over print personality, what basically they're showing us is that they don't care that we see what their position is. So when I see something like that, that's something that I'm going to be looking at longer term, because do I know if it's going to happen tomorrow? Not really. I mean, there's certain type of prints that could come up that could give us an indication that it's going to be in a shorter term time frame. But especially, for the options traders, that's the type of prints that I see that I'm going to go at least a month out, maybe 2 months out, maybe, some, depending on the stock. We've been looking at Pfizer, so PFE, where if I see something like that, it could be over a year. So I'm going to look something, for something way longer out. But where I've actually had my most success in swing trading is prints that show it should happen today. And what I mean by that is that off-level prints, and what off-level prints are basically stocks that are moving, in a print personality, let's say for 4 or 5. And when we see prints come into it that are literally off level, so they're not a 0 or 5. So it could be 501, 502, 503, 504. It's somewhere in that area, and it's showing us that something should happen in the very near future. So when I see prints like this that come into a stock and they don't actually come to fruition that day, this is where I've been finding most of my success, is that within that next day, we can almost expect, and there's no such thing as a guarantee, as we know, there's no such thing as 100% within any type of trade, but we can kind of assume that it's going to happen very quickly. And when I say very quickly, like I said, overnight.
Gotcha. So when you have that swing trade setup or that overnight setup, I should say, what kind of stocks are those? Are those everyday stocks or are those newer stories? Or do you find one happens more than the other in terms of newer stock or an everyday stock?
Check.
I can hear you.
Okay.
Can you hear me?
Yep.
Sweet. Apologize for that, folks. But I also had a question. I know you got cut off a little bit, but I think it fed really well into the next question I had was, uh, what type of stocks do you normally see that setup occur? Is it new stories throughout the day, or is it stocks that have a full story and have previously been trading and you've been monitoring?
So most of these stocks have some type of catalyst. So
Okay.
when we look for our stocks, and every stock that I'm going to be watching throughout the day, or just starting with the morning, or something that pops up in the pre-market. So I like to look at the active gainers and the active losers. All right. Basically, what that tells me is that there's a bunch of volume and there's a bunch of movement that happened already that should essentially lead into into the open. So most of these stocks, a stock like Apple, that's not really, and the same situation can happen, but I'm not really looking at the blue chip stocks. I'm looking for something that's almost brand new. And the way I kind of explain it is that there's certain stocks that have a story like a textbook, and there's certain stocks that have cliff notes. So the cliff note story is going to be something that just popped out of nowhere. It's going to be short. It's happening today. There was nothing yesterday that really showed that much. It really is happening today versus a stock like Apple where it's a textbook. I mean, every day there's going to be a story within the prints that are happening in those stocks, and I call them everyday stocks because they literally trade every single day.
Gotcha. Okay. So that's kind of like your main approach then is the whole overnight setup. If the stock doesn't do what it said the prints were going to do today, you kind of take that into consideration. And are you holding shares or are you trading more options with that? How do you approach that in terms of the overnight?
So options, the only time I trade an option is that I have to research the company.
Gotcha.
So I don't, and I know this sounds funny, but you don't go to bed with somebody that you don't know. So overnight, if I'm gonna hold for a extensive time period,
Mhm.
for a month, for something like that, I'm usually going to use the option just because I have the leverage that comes within it. It's cheaper and it's in my opinion just a better vehicle to use for something that's going to happen for the longer period of time. But let's say it's a cheaper stock, something let's say less than $10 that comes in. Okay, and I don't have the research on the company, and I don't really understand exactly what the infrastructure is going to be. That's when I'm going to use the strategy of finding those shorter term prints that should have happened but did not happen. But one big thing that I'm very adamant about is that I'm up early. If I'm holding a stock overnight because it didn't happen before, a lot of the times you're going to see it pop up during the pre-market, but end up coming back down. You see that
Mm.
sell-off coming during the pre-market. So I've got to make sure that by 8 o'clock, I'm sitting there ready to look at what's happening with that stock.
Gotcha. Because that buying, if we're looking at it from that perspective, could be satisfied within that pre-market. So
I can't tell you how many times being lazy and getting the computer at 8:15 rather than 8 o'clock, where the stock ends up popping up and then coming right back down and not actually being able to get the full profit on it. So if I'm gonna take that strategy, I got to make sure that I'm up at the computer sitting there for when
mhm.
the real, typically you're going to see a stock move at about 8 o'clock. After a gap up, even after a gap up, typically it's going to be, but it could happen as much as 7 o'clock. So, I can't tell you how many times I've been sitting at the computer at 7 o'clock. Nothing's happened yet. There's not even enough shares to actually get out of your position from. But just sitting there kind of being ready for what I was expecting to happen. Price target in this case is so important. Based off the
Mm.
prints that we see originally, my price target, if it hits that, I'm not looking to go crazy. I'm not looking to, to get greedy and to see it go any more than what I expected from the prints I saw.
Right. You're
So
just really trying to capture that overnight move because at the end of the day, we're day traders, right? So when the market opens, we can always get back in.
that's exactly it. Because if it's going to continue that volume, especially on stocks that are less than $10,
Mhm.
they're kind of 15 minutes of fame. A lot of times you get these beautiful moves that come up in them, and they're really high percentage moves. I mean, you're talking about some of them 50, 75, 100, 150%. We've been in the thousands of percents before. You've seen in the chat room before. But I'm not looking to do anything crazy. I'm just trying to get the move that it should have happened, but a lot of the times it's just going to happen overnight.
Right. And then at that point, you just reevaluate your risk, essentially.
100%. So really what I do is I kind of set a point where if it's gonna, let's just make up a number. Let's say, the stock from underneath 5 shows that it's gonna pop up to, let's say 6. So at 6, I'm not willing to lose more than 50 cents of profit. So 550, that's it. I'm going to be out, but I need to make sure that I'm actually at the computer to be able to do that during the pre-market, because it happens so often.
That makes sense. Well, I think that's a great little sneak peek into a series that's to come, and I think a lot of people have been really looking forward to, just diving more into the swing trading aspect and maybe seeing some examples. I think that would provide so much more value. So appreciate that little sneak peek. And the next transition I wanted to get to was thinking in probabilities. This is something I've been on my mind in the past. Well, it's something that you've taught us as well. I mean, within the tape and tape reading, we define percentages to everything. But more so lately, I've just been thinking about what does it exactly mean to think in probability, and why is it so essential to tape readers' success? Because I know that when I first was thought thinking in probabilities was defining your risk to reward ratio, but in reality, that's kind of not it. Your risk to reward ratio is a major key of your trade, but it's not also the probability of the trade, because a lot of times I would not define my probability of the setup in the trade, and then I would set my capital management would be off. So I would have a set number of shares. I would trade 1,000 shares, and my probability of the trade would vary from 60 to say 90, and I'd be taking the same amount of shares, and I would stay frustrated with that. And I think it's not till like this recent year where I really understood and developed the fact that thinking in probabilities really helps with capital management, also some emotions. So I really wanted to kind of pick your brain on what does it mean to think in probabilities as a tape reader from your perspective.
So one of the most interesting things about thinking in probabilities is that no one ever wants to be wrong. I mean,
Right.
it's part of being a trader. I mean, I remember when I first started, I was in sim trading, and I had bad days, like bad days where I went home upset because I lost in sim trading. But the one thing we have to understand, there's no such thing as 100% in the market.
Right.
It's never going to happen. So what we have to understand is that when we go into a trade, there's a probability of it going correctly and going to where we want it to, and there's also a probability of it being wrong. So let's just put this out there. There is always going to be a probability of your trade that is going to be wrong because of the fact that there's no such thing as 100%. So see, capital management has nothing to do with your percentage to a certain extent. It does in the way of if a trade is 99%, and obviously, this comes within the methodology that you're using, but if a trade is 99%, well, I'm going to put more capital towards it.
Right.
I don't really look at it that way as much as I look at what is the probability of my trade working out. So the first thing I start with is prints, always. There's no trade I will ever take that doesn't have the print in it that shows definitively what the market maker that I'm looking at tells me what they want to do. Okay, the most I can ever assess from prints alone, because it's not just about prints. Now, if you just hold your trade forever, eventually, is it probably going to be right? Yeah, but we can't trade that way. Okay, we have to have a specific and set game plan. So the most that I'll ever put to prints is 60%. So let's say I got a huge amount of buying. I can tell you to a 60% aspect that stock is going to go above where we saw that huge buy. But that's not enough, because if you really think about 60%, it's almost a coin flip.
Right.
I mean, think about it. It's not really, giving us exactly what needs to happen. So from there, I'm going to go to what those prints actually tell me. So we go back to what we talked about before with print personality, where print personality tells me what an average position looks like. Now, an average position should make money that day. So if, let's say, it's way over print personality on ask prints, which is buying, I'm going to be expecting that stock to come down to a certain extent. Now, there's something called a trigger. It's price, action, and volume that kind of sets off where the stock is looking to go. Now, the most that I can ever put to that is 10%. But the thing is that when the prints themselves, the prints that we're actually going to be following, tell us to a certain extent how much it either needs to pull back or how much it doesn't need to pull back. In this example would be ask prints, because a huge amount of ask prints above print personality essentially is telling us that the stock needs to pull back. So in order to have a 10% trigger, because that's the most that I could ever put towards a trigger, it has to pull back the amount that the print said. So if the stock is trading in 50-cent increments, what that's telling me is that it has to pull back at least 50 cents before I can even get 10% on my trigger. Okay, so that now, if let's just make up a number again, and let's say it's $10, and the stock needs to pull back 50 cents, I can't get a 10% trigger back towards the upside until it's at least below or at 950. Okay, so that's where 70% trade comes from. But then the rest of trading comes in, because it's funny when you ask about percents, it's essentially asking how do I trade?
Right.
And when we talk about that, it really what it's coming down to is the fact that there needs to be other variables added. Now, whether that be print lines, and what we call print lines are shares, that one print that comes in over 100,000 shares. Okay, that's a variable that I can use. I can use a variable of a support and resistance. I can use a variable of off-level prints. There's a lot more that's going to come into it. But essentially, the key to this game is being able to understand what a 70% trade is. And that comes down to controlling prints, which are prints at a level, either at print personality or above print personality, and then a trigger, which is going to be price, action, volume.
Check.
Can you hear me still?
Yeah. Okay, you cut out there for a second. I didn't know if you were back yet. So 70% with the controlling prints, and then 10% with the trigger. And we also have a variety of
60% with the controlling prints, 10% with the trigger.
My bad. And then we also have different variables such as off-level prints, ballsy prints, leak prints, psych levels, orb lines, print lines.
And that's where the rest of trading comes in, all those variables.
Yeah. And those are kind of, those obviously are the little pieces to the puzzle that really can add make that trade a high percentage, really.
Oh, 100%.
Yeah.
But see, that's the thing, is understanding the 70% first, because not all prints are going to give us 60%, not all triggers are going to give us 10%. So right. You might have a 50% trade with good prints and a decent trigger, but that's a coin flip. And that's not what we want to take. We want to at least be able to have that 70%. And then from there, when we add our variables, that's when we go into the 80s, the 90s. And that's where we really see consistent trading.
Right. And as students, I know some students, they struggle with the controlling prints of allowing it to pull back to the proper amount. I know that is one of the learning curves as well, is because if you don't allow the stock to properly build, then you're taking that trigger up to the upside, you thinking that's a 70% trade is really, really low. It's not really that. So that can,
you're sitting at 30% now.
Yeah. So you think, okay, I got the pullback, this is what I thought, but the increments and the market maker printed above print personality said otherwise. And that's where you can get in that grounds of like, I'm doing everything right, but ultimately your foundation of what needs to occur is a little off.
That's exactly how it happens. So the key to really starting to tape read is really being able to understand that 70% and understand where you are from there. Because not all prints and triggers are going to be a 70% trade. And if you're lower than 60% and you're trying to take trades, you're essentially coin flipping.
Gotcha. So with capital management back in mind, so say we have the foundation correctly and we're more experienced, we have our other variables, and we've added up to about an 80-90% trade. How do you approach your size? Are you with every trade? Like, is it different personalities that suggest different types of shares you're going to approach it with, or is it just like what's your mindset when it comes to your shares?
So at this point in my trading career, it goes down to what the orders allow.
Okay.
So if being a retail trader, you can't just go out there and buy 1 million shares at once, because if they
Right.
see that, they're going to take your 1 million shares from you. And the reason that this actually happens is because in order.
Check, you cut out. Apologize about the audio, everyone. Might want to unplug your microphone and plug it back in, Rich. Some audio difficulties here. Might be on my end, might be on Rich's end. Just bear with us, please.
This conference will now be recorded.
Recordings up.
Sorry about the audio issues, guys. So the question I was asking to Rich was, how does he approach his capital management in terms of his probability at this stage in his career? And then he started talking about you can't really print 1 million shares at a time. Market makers can easily find you and take your shares from you. So with your approach with that, Rich, are you scaling in?
Okay, yeah, I apologize. I don't know what's going on with my headset, but yeah. So the thing is that it gets to a certain point. So, if you trade 1,000 shares, no one's really looking at you. 2,000 shares, not really. 5,000, they start to look at you a little bit. Anything over 5,000, now you get to the 10,000 to the 20,000. They know that you're in at a position like that. Okay, so capital management really, what it comes down to is that, first of all, what does the stock allow you to buy? Because if you look at Siri, SIRI, I mean, it trades millions of shares per second. The orders are huge. So if I were to buy 100,000 shares, no one actually sees me. But then you could come to another stock that has thinner orders, and 100,000 shares is really going to show up on that. So it comes to a point, it's not even more about capital management. Now, don't get me wrong, the higher the percentage of the trade, the more shares I'm going to trade of it. But it's what can I trade without really throwing out there something big for the market makers to see. So it almost comes to a point where it's a lot different. It's not just, but if we bring it back, can you still hear me, Dave?
Yeah, I can hear you.
Okay, so coming back, so if we go back to what a normal trader is like, it comes down to if I told you something was going to happen 99% of the time, how many shares would you put into it?
Put the whole count in.
That hopefully not your whole account, but you're gonna put a lot there. So one of my suggestions that I would have, especially in the beginning parts of upping your shares, is have a set amount. This is the amount. This is the highest amount that I'm going to have. So let's just make a number up. Let's say 5,000 shares. So based off of that, for 5,000 shares, if the trade is 70%, well, I'm probably not going to trade 5,000 shares. I'm probably going to trade 3,000. Now, if the trade is 95% or 90%, I'm going to be as close to that 5,000 as possible. So I don't look at it as, the monetary amount of what the position is going to cause. And the reason I don't have to look at it like that is because I cut my losers immediately. And when I get into a trade, I already know exactly how much I'm willing to lose on that trade. And I use a 1-to-4, 1-to-5 ratio. Basically what that means, if I can make $1, I'm willing to lose between 20 and 25 cents. Okay, so it comes down to, in the beginning parts of things, set a number. This is the total amount of shares I'm comfortable trading at this point, whether it be 1,000, 2,500, 5,000, whatever that number is. And from that percentage, you scale from there. And then one thing that people forget is that it doesn't matter how many shares you're trading. Whatever you're still going to be scaling out of your trade at the same percentages. So just because you have 5,000 shares doesn't mean that you need to get out of 90% when if you would have had, 500 shares, you would have gotten out 20%. Because then you're thinking in a monetary way rather than just thinking about the game and thinking about how trading works.
So the approach is the same, no matter 500 or 5,000 shares.
Really doesn't change until you're above 10,000. Then you have to start worrying about market makers looking at you, but that's a whole different topic for another day.
Right, that's a lot more advanced, and once you get to that stage, you've made it at that point. So
Yes, sir.
So I think that we really hit the probabilities and then the capital management as well. So I appreciate having you on, Rich, and I appreciate you taking the time to answer some questions, and I'm glad to have you back. And we have a lot more content to come, and I think a lot of our students and members are really excited about what's to come.
All right, Dave, I think so too. All right, coming into the new year, we have a lot that's going to be changing. So I'm very excited about that.
All righty, Rich, take care.